In this video, I want to discuss a little bit the old debate between value investing and growth investing, value stocks and growth stocks, and I just have a few thoughts on the subject. And it's a topic that has been on my mind lately because I used to call myself a value investor, for if maybe some of you noticed. And recently I switched to calling myself a retail investor. And that is both because the dividend strategy I'm currently focusing on is not your classical value investing, kind of swing trading, maybe closer. But yeah, I don't feel that's exactly value investing. It kind of contradicts, goes against a lot of the value investing fundamentals. But also, I feel like the value investing I used to do before this strategy, my stock picks, where I thought there was value in them, and I did see them as value plays. I more and more gradually understand that that was more of a growth investing, and I will discuss about whether there is a difference, how I think about it, and again, the old debate if we should really make this distinction between growth investing and value investing. So yeah, I don't know how long this video will take. I have quite a few examples. I will probably not use all of them. And I'm starting while the sun is still shining, but not for long. So I might end this video when it's dark already. But let's do that. So I don't know if I really need to discuss like the classical examples of growth stocks and value stocks, and I feel like most of us already like have the feeling where growth are high growth companies when you kind of count on the future growth of the company, and maybe in today's terms it's not a big company yet, but you have big hopes, or investors have big hopes for it in the future. So that would be your classical growth stocks. They might be profitable, they might be not profitable, and soon when I get to the examples, I will focus more on the profitable companies, but they might not even make money today, but you count on this growth and this turning profits in the future after the big growth phase has completed. And on the other hand, you have your classical value stocks, where the old school, the traditional value investing was even calculating the assets of the company and finding this discrepancy between the current value of the company, how much would it sell for today, or what's its current value today, and the price of the company today. And if there is a gap between the value today and the price today, that would be your typical value investing stocks. But there is the school of thought led by Warren Buffett that has famously said that he doesn't see a difference between growth and value stocks, and I'm gonna try, I hope I'll make it, to cut the video about it here from Berkshire's shareholder meeting.
You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that? And do you prefer a growth company that is selling cheap, or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it, or the cash that's going to go into it. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case again is the airline business. The airline business has been a growth business ever since, well, that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public, but growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. The real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
But I don't want to contradict the Oracle of Omaha. I mean, I'm no one to do that. But how could Warren Buffett know for sure what would be the growth of See's Candy in the future? And how could he know for sure that See's Candy would even grow at all in the future? I mean, starting from next year even. And I feel like this is the million, billion, almost trillion in market cap already dollar question, where how can you know that this company will continue on growing, because there are so many companies like See's Candy that did not manage to continue grow and even declined eventually after a few years, a decade, 2 decades. So I feel like this is even a different question, a different topic that is kind of, I feel for me, like really the $1 trillion question, but it's not even in the scope of this video, where I do want to talk specifically about the growth. I mean, you still, when you think of value investing and growth investing, which they are the same, growth is just one of the parameters you are using in your calculation, but you do make assumptions about the future growth of the company in the next few years or long term, and those assumptions might not materialize. And I will get to the examples soon, and I will conclude it even more definitely in the end. But I think there is a big difference between making your calculations and calculating your intrinsic value for a company and how much would you be willing to pay, what you think the fair value is, what would be your margin of safety, everything, all the calculations you make. I think those calculations are very different when you're accounting on the continuance of the expansion of the business, rather than just using what the company is already doing today, what has already materialized, what it already succeeded on doing. There is such a difference between like speculating on success in the future and using the success that has already been. And this is kind of my conclusion already. But I have a few examples where I want to demonstrate that and show that, and again, drive this point even more home towards the end of the video. And in my discussion today of this topic and in my examples, I kind of want to focus the scope on more on actually dividend stocks, which is what I am and probably you are also interested in right now, and kind of cut from the edges the super high growth companies which are not profitable, which I will not talk about today, and the like cigarette butts or net companies. From the other side, I might have like a cigarette butt maybe like example today, but like focus more on dividend stocks and like more of a solid, long track record, more established companies, and still talk about how growth versus no growth really affects the future, the expectations of the stock and the valuations, and how it changes the style of investing. And I do think it does change the style of investing a little bit, and also the risk reward profile of those different styles. So I do want to focus today more on dividend stocks, but not necessarily even dividend stocks, but stocks that are more like solid, old school, boring businesses, which are not hyped. Maybe they are popular dividend stocks, but not like overhyped stocks. But just before I get there, I do want to show a few examples, maybe just two of typical high growth companies, which just to illustrate that for a moment. And then we'll get to the dividend stocks. But this is a Zoom, which we all know. We probably all know what happened with it during COVID, when it had really exploded, and it had a super high growth up until 2022. And then, of course, the price was over like exuberant, because everybody was counting on the continuance of the growth. Of course, this is just profits, and I'm not even talking about companies which are not profitable at all. And of course, all the growth is only in the revenues, and the investors are really looking at the top line growth, at the growth of the revenues. But here is an example of a company with earnings, with a high growth in earnings also, which is already a step above the high growth, no earnings companies, which grew at very high rate. And what happens is when a company grows at a high rate, the market gives it a very high multiple and very high valuations. And then when the growth is slowing or stopping, the price is falling. And so even if the company continues to grow, albeit in a slower pace, or it stops growing at all, and not even talking about the decline in revenues or in profits, the stock is getting absolutely hammered like it did here. So we see that now Zoom, for example, that has gotten to a PE of even 200 something at its peak, when growth is suddenly stopped or slowed, it began trading at a PE of 15, which is a normal, absolutely normal PE. I mean, it's not necessarily a bad company, but a multiple of 15 is absolutely normal. And we see that even if the company is doing pretty well, I'm not sure how Zoom is doing. I've never researched it, probably never will. But even if it's doing fine, shareholders lose a lot of money. Obviously, when this correction between high growth and no growth or low growth is happening. So this is an example of a growth stock, a classic growth stock, which its growth has already slowed. And again, the high risk with growth companies is when the growth disappears. And we see here how it materialized. So my next example is just a classical growth stock today, Alphabet, that everybody is loving so much because it's growing every year for 27%, 32%, 91%. No, okay, 21, 12, 22%. Google has been growing really nicely for many years now. And the market, of course, is expecting for Google to continue growing at this pace, in the pace of 13% next year, 15% after that. And therefore, gives it a higher valuation. It is trading currently at a PE of 22.8, and it's even a little bit below the historical normal multiple of 25. So the market is giving it a high multiple because, of course, it's also Google and it's one of the big tech companies. It has a credit rating of AA+, but also because of the high growth. And here I want to ask you, what will happen with Google and with its stock price if we don't know if growth suddenly slows, and it can happen. I know it seems impossible for a company like Google to stop growing suddenly, but it absolutely can happen. And I'm not even meaning growth in revenues, but even growth in earnings. I mean, it can grow in revenues, but suddenly it's going to have elevated expenses, or there is a higher price for this growth, or they have like investments, capex they are doing right now for the future, or they are being disrupted by AI or whatever. So it can happen. I know it sounds unfathomable. Maybe not this year, maybe not next year, but it can happen a year after that. Maybe it will happen next year, maybe it will not happen. But the risk of the growth stopping, and what will happen then, will it still be trading at a 25 PE, at a 22 PE when the company is not growing, and it's unclear when growth will resume again and whether it will. And so this is a huge risk. So you can say, yeah, but this is also like, if you catch it, I don't know, maybe at this point, okay, you can say, no, but it's also a value stock because there is some value here to be had from its true earnings power and from its from the economics and the fundamentals of the company. Yes, but you're still counting on this growth going forward. If Google here, it had a decline in earnings, and if this decline would continue, of course, I'm not even talking about declining companies, but even if the earnings would have been flat for a few years, the stock price would not climb up again, and it would trade at a lower, I mean, even here, it was still a 19 PE. If suddenly, okay, and this is just an example, I'm not saying anything about Google specifically, but if something would have happened that would make earnings flat from this year, then the PE would probably again normalize towards the 15 PE in most cases. In some cases, it's a different PE that the market gives companies in no growth situations, but it would probably be around 15 PE. I know it's unfathomable to think that a 15 of PE could be applied to Google, to Alphabet, but it can happen. It can happen tomorrow. And then the stock price would be even lower from here. And this is even when you invest in high quality AA plus rated $2 trillion market cap top quality company like Google, this is the risk that the growth will stop, and it happens all the time. So now I want to give a few examples. Let's leave a little bit the world of classical growth stocks and look more at our scope, our style of investing, the kind of companies that we usually look at in this channel. So here is an example of a high growth dividend stock, which is a typical dividend stock, dividend company that is loved by dividend growth investors. And I want to kind of demonstrate the same point with it, that maybe when you look at the graph, it's obvious now that it's kind of the same story, but I think that people like classify like Google, Meta, I don't know, Uber, Tesla, like in one category, and then they look at companies like United Health in a different category because it's like a more of a solid old school company, and not like cool and hype-ish one. But still, if we look at it, it has a very high growth of 13%, 17%, 13%. We see that it was growing long term in the past decade and a half for a rate of 14%. And the market has given it a high historic valuation of 18.8%, almost 19%. And one could say it's not so high valuation. It's not so far from the 15 multiple, but hold that thought, because I will show in a few minutes how probably the normal multiple of when United Health stops growing is much lower than 15. And I will show it in a minute. But I want to again ask, what will happen if United Health growth suddenly stops? What if it will be flat next year? Will the market still give this PE to the stock if the growth slows? Of course not. And it's going to be much lower if it's flat next year. But what happens if it's flat for many years? Well, I'll tell you exactly what happened, because it just happened to United Health's peer, Elevance, used to be Anthem. And this is Elevance, a peer of United Health, where they're both in medical insurance. And Elevance Health is, for me, such a good example of the point that I'm trying to get across here, where investors see this high growth and there is the assumption that this growth will continue forever. And I don't know, it might continue, it might have a few slump years now, maybe just this year, and might continue from next year or a few years. It will take for Elevance's growth to continue, which, by the way, we don't know about Elevance. We have no idea. It's too much dependent on politics and regulation, close parenthesis. But the market was giving it a high valuation because of the high growth. If we looked at this graph just 2 weeks ago, we would have seen this perfect graph of growth. But you see that the growth is so high, and it's an insurance company in Medicaid and Medicare Advantage and all of that, where it's growing 20%, 12%, 16%, 22%. It's a super high growth. How sustainable is this growth? I don't know. I haven't researched this company well. I did just a quick checkup, but it was obvious for me that there is always this risk that the growth will slow and the earnings will be flat. I'm not again talking even about declining earnings. And then the valuation just drops, because before, while the stock was growing at a 12%, even more, if I take this range to around here, we see that in those high growth years, it was growing even 18% in average, and the market was still giving it a 16 PE while it was growing 18% in earnings. So how much will the market give this company, Elevance and United Health, its peer? What I was saying, that probably the normal multiple it will give it if the company is slowing its growth or flattening its growth is going to be much lower than the 15 PE. It's probably going to be closer to 8, 9, maybe 10, I don't know, maybe 7 PE. And right now it's still trading, even after this sharp fall in the share price, after the company has just reported its earnings are going to be flat this year. Even after this fall, it's still trading around 13 PE. It's still pretty high. I think at this point, the market is still expecting the company to continue growth after this temporary slump. But what happens is suddenly there are some changes in regulation, something in the law, something in the dynamics, something in the competitive environment, when the earnings are going to be flat for a few years, for a few long years, like 3, 5, 6, 7 years, maybe even decline a little bit. Of course, if earnings decline, there is no bottom to the share price and to the multiple. But we can say that even without significant changes to the fundamentals of the company, to the value of the company, even just on this point that the growth has gone from a 13, 17, 12% annual growth to 0 annual growth, and with still expectations for growth to continue in the future, we see this sharp decline in the valuation that the market is giving to the company. And again, I think we can go even further down if it's going to be suddenly clear in a quarter that next year is going to be flat too. It's going to get absolutely hammered. And this is exactly what I'm saying about the difference between growth and value, because when you invested in it 2 weeks ago, 2 months ago, 2 years ago, you were counting on the continuance of the growth of the company. And this growth can stop in a minute. I was looking at this graph 2 weeks ago. A subscriber wrote me Elevance as an example of a very high quality dividend growth stock. And I was looking at it, the graph was perfectly growing still. And here we are just 2 weeks later. And what I feared most when I looked at this graph exactly happened. And this is why I am looking for this undervaluation. This is why I'm not so keen on buying those companies, those high growth companies, which again, I don't think a lot of people would classify relevance as a high growth company, but buying a company with, yes, it is high growth at a fair price, like a great company with a fair price, you're taking this huge risk of the growth slowing, stopping, and then the share price is falling, and the re-evaluation, it's not even a temporary fall, it's a complete re-evaluation of the company by the market with the new non-growth situation. So yes, I think it's a big difference. So I don't know if I'm gonna go over all the examples, because I'm kind of feeling I've got the point already across. So just to give, I don't know, just to give one more example of a growth company, and then I will show some examples of a value company. So I don't know, let's look at Starbucks. I have a few examples written, but so this is Starbucks, and Starbucks is always overvalued. Okay, so there is kind of no value here, obviously, I think, for most of us. But what I wanted to show here, that even when the stock dropped, when the stock price dropped, and it went from a multiple of like 30 PE, maybe 25, 27, 29, 30 PE, to a multiple of 20 PE, and one might consider it a value because it seems like it's historically undervalued, and it might seem like now it's a good buying opportunity, and so it kind of seems like both growth and value. But we have to see that this happened exactly on the news that the earnings are now pretty much flat during the past few years. So when Starbucks was here growing still at a pace of 19, 21, 23% annually, this high multiple of 31, still, I think it's a bit rich, but okay, we can at least justify it with this high growth. But now that in the last few years, the company is not growing its earnings, even after this fall in the multiple and in the price, still a PE of 20 for a company that is now seemingly not growing, and next this year it's gonna be even a bit negative, and we don't know when growth resumes again and whether it will. A multiple of 20 is very rich still. If an investor is thinking that this is a value opportunity, he is counting on this growth in his mind, because he thinks that the company will continue growing, because if it will not continue growing, in no way does it justify a multiple of 20. So if those were examples of growth stocks and growth investing, what is value investing, and where do I find this difference? So I will give a few examples in a minute, but where I find the difference between value investing and growth investing, and how I see value investing, is when you see value in the company, when you see value in the current valuation of the stock price of a company, even if there is no growth from the current position, the current economics, the current fundamentals, or the past maybe fundamentals of the company, you still think there is an upside, you think there is a margin of safety, and you think the company is worth more than it is traded at right now, even if there is no growth. So let's look at a few examples, and I hope I have a diverse enough examples. Yeah. So my first example is Altria Group. So this is a stock, this is a tobacco company, which I own, and this is, we do see here the growth of the company, but it's essentially not really growing in revenues. The current growth is only due to share buybacks, mostly. So this is really a company that is not really growing. We will look in a minute in a few examples of companies who we do see a flat graph, but my point here is that the graph doesn't have to be flat for us to know that this company is not really growing. And still, I think there is an upside here. And I think if you don't agree with me, you don't have to invest in it. But just as an exercise to understand that even if the company will never grow again, it will probably not decline also. Of course, if it declines, there is no bottom. But even for this value, the current valuation, this current current size, the current revenue, the current earnings of the company, Alex, think it is worth more. It's currently trading at a PE of 10. I think it's a high quality company. There are, of course, a lot of risks with it. And the reason why the market is giving it a lower multiple, but I still think it's a multiple that is too low for a high quality company. There are a lot of things that are high quality in it. I don't want to get into a discussion and an analysis of Altria Group. I just want to make the point that I think it's for the price it is trading at right now, even with no growth, even when taking into account that it might not grow in the next few years, I still think it's kind of cheap and it has a margin of safety, and that the company, even if it doesn't grow in the next 10 years, is worth more than it is trading right now. And that's value investing, where I think that there isn't currently an upside, even if the company is not growing. So we see this growth of 3-4%, which is driven mostly by share buybacks. The company is essentially not growing, and it's trading at a multiple of 10. I think it could trade higher. So whether you agree with me or not, or specifically on Altria, just the concept when you think that the company is worth more, even if it doesn't grow, that is value investing, when you don't count on the future growth of the company for its valuation, for calculating its intrinsic value, that if you take the growth factor out of it, it's worth like 3 times less, which is often the case with growth companies, with high growth companies. So my next example would be Alibaba. So Alibaba has been a high growth stock until all hell broke loose with it. So it was growing at a rate of 1639%. So it was a high growth company, and the market was giving it higher multiples. So the orange line here is 30 PE. So it was trading around 30 PE if we look at this range. And the company was growing very nicely, and the market was giving it a multiple of average multiple of 31 during this period. And then it had a small decline in earnings, but mostly since then we can say the company is overall, its fundamentals are pretty much flat. So this is company that was growing at a higher rate, and now it's pretty much flat. It's pretty much not growing. It had this decline after the COVID bust and all the issues in China with the crackdown and the slowdown and everything. So now the market is giving it a multiple after it was given it a multiple of 31. Now when the company is flat, it is given it a multiple of around 10, 11. And this is exactly, it's amazing. I didn't plan it, but it's exactly the example of a third. Like I just said, that going from high growth to no growth in the same calculation, you get a third in value, 3 times cut in the valuation. So exactly what I was meaning. And now the company is trading at a PE of 11. And when you zoom out and you look at Alibaba, one of the tech giants of China, all the assets it has, all the intellectual property it has an A+ credit rating, low debt, a share in buybacks now, dividend, still it has some growth in it. But even if it doesn't really grow, even if it grows at 2%, like it is expected to grow this year, I think, Alex, I am invested in this one, one of my biggest positions. I think it really justifies a multiple of much higher than 11. And I know all the market is now pessimistic about China. It might be justified. I know why. I can't say I'm very, very optimistic about China, but I think this company, looking not at the macro level, but at the micro level on this company, it's a high quality company. And I think it is worth much more than 11 times earnings. So this is, even if it doesn't grow, I think this is a value opportunity. Still, it is already up significantly in the last couple of months, but I think there is a lot of upside still to be had here. I think a multiple of 15, normal multiple, would be just the absolute minimum and normal for a company like this. So maybe I don't know, 14 maybe because of the China thing. But I think it's absolutely fair. So I think that even if the company doesn't grow, there is still an upside here. And this is value investing. When I do not count on future high growth or even growth at all, I think that even if the company doesn't grow, it's worth more than it is traded at right now. So this is Baba. And just to give a last example, well, I have two more good examples of value investing, which are a bit different. So I will show them both. Maybe I'll cut it eventually. And so this is a Norwegian cruise line, NCLH, and I just wanted to give this example because it's a little bit different, and just to classify it. Is it growth? Is it a value? Is it a turnaround? Is it something else? So obviously I am invested in this one. All the stocks I'm giving here in the value section are stocks that I'm invested in. I have a small to moderate position in it. And yes, I do count on this growth going forward, but it's not like I am, but it's more of a turnaround situation, and I classify it more as value investing also, because it's not like I'm counting on the future growth of a Norwegian cruise line based on its new ships or expansion of business or like expanding to new geographies. Of course, it all helps, but my basic thesis is that it could more go back, revert to its normal earnings power it had before COVID. And of course, it's again, I don't want to get in too much into the analysis of the company. Yes, it is a different company now. It has much more debt and it has much more expenses, and everything changed after COVID for it. But still, I believe, and again, it's not the point of this video whether you agree with me or not, but for me, I believe that it could, even if it doesn't grow, if it doesn't launch new ships, even if it doesn't expand to new geographies, even if it doesn't manage to increase onboard spending and all of that, I still believe that it could increase its earnings just based on what it already has today, on what it already grew in the past, what it already had before COVID hit, where I think there will be more of a normalization of its earnings to its earnings power that were always there even before COVID. And of course, it might be lower now, this earnings power. So I'm not necessarily counting for NCLH's earnings to go back to this point, but I still think it can get much higher than where it is right now. And again, not based on like future speculative growth, but based on what it already has today. So that's a huge difference, and I think that does mark the difference between value investing. For me, it's maybe semantical, okay, but for the distinction that I am making now, marks the difference between value investing and growth investing. So my last example would be just to show a little bit of a different example. Pfizer. During the years that it did not grow, so Pfizer is a no growth story. It's a company that is not growing. I did a video about it, which no one watched. It's okay, no hard feelings. But I think YouTube is just not showing it because I talked about COVID. But if we look at the years before COVID and the vaccines and everything, if we take out this 2019, okay, let's leave 2019. We see basically a no growth story. So Pfizer is a company that essentially in its fundamentals probably is not growing. And but my point being that you can take a no growth company, and I think a lot of investors a little bit miss on that point, where a company doesn't necessarily have to grow for it to have value. And that's exactly my point with this video, that even when Pfizer is not growing, it's still worth a lot. It still has its high value, and it has its price, its fair price, where it could get undervalued with no growth, and it can get overvalued with no growth. So if we look at this period where it was not really growing, and we see the earnings level is pretty much at the same point, we see it went really from periods of undervaluation to a period of a bit of an overvaluation. And if you decided, okay, it's not big brains to invest in the peak of down market, one of the biggest recessions we ever had, but if you invested in it, for example, here, when it had a multiple of 8, I don't want to talk only about multiples, but just to simplify this concept, when you think it's still cheap relative to its fair value, even when it is not growing, I think there is definitely some value to be had here and some upside to be had here, and a margin of safety from this price to its intrinsic value at this point. And this is value investing. You do not have to have growth for a company to have its worth, for you to calculate the intrinsic value of the company and have a general idea whether you have a margin of safety, whether you have an upside, or maybe it's even overvalued when you have more of a downside than an upside. So those were kind of my examples. And so just to make a few conclusions and sum up the whole topic. So for me, I think there is, my conclusion is yes, there is a big difference between growth investing and value investing. And of course, there might be some gray areas and some cases where it's a little bit of both or kind of neither. But overall, if you look at most stocks, you can kind of classify whether people that are investing in it right now, like counting on the continuance of the growth of the company, and they're taking it to consideration in their calculations. And then I think it's more of growth investing. And on the other hand, value investing is when you think there is an upside, that the company is currently trading at a cheap price with a margin of safety, even if there is not significant growth for it in the next few years. Of course, it's first of all, it's all semantics. If you say, no, I find value when there is a high growth company that is trading at a lower valuation, and I think that's also value. Yeah, of course, fine. That's also value, but it's just a different characteristics, and you still need to take into account what will happen, and it can happen to every company if growth slows. And then when it does, you will look in hindsight and say, I kind of invested for growth. And that is exactly why it happened to me. I'm speaking from experience, and I'm kind of right now in a kind of in a crisis, kind of slump with my growth/value stocks, which are not my dividend stocks in my portfolio, when I was initially planning on holding them until we get out of this like tougher macroeconomics times. They are all cyclical stocks, and I invested in them while they were growing in higher rates, and now they're flat or even declining, most of them, where I still believe that from current price they will someday resume growth. But I'm sick of waiting for this growth and counting on this growth, and I understand now how much when I bought them. Let's look at an example. So this is Malibu Boats. I invested in it in 2021, and I know it was a big mistake. I made many mistakes with it, and I talked about most of them in my older videos when I talked about my investment mistakes, and I completely missed on recognizing the boom that was happening during COVID from all the stimulus money and stimulus checks that were flowing through the economy, and the special environment with the lockdowns. And I saw this high growth, and I might have known that this much of a high growth of 83% will not continue, but I still thought the company would continue on growing on, even if at a slower pace. I did not recognize the possibility of a bust after the boom of the COVID, but that's a different topic, which I already kind of talked about. But what I wanted to show here, that when I invested in it, it was somewhere here. And it was trading at a PE at that moment of 10 for a high growth company. It was 23%. I knew that wasn't the intrinsic growth of the company, but the intrinsic growth might have been around. Then it was growing around 15%. Okay, let's say, and And for me, a company that is growing at 15%, that is trading at a 10 PE, it seemed like really a value opportunity. I mean, I thought I was value investing in value, and that there was a margin of safety here, because considering the future growth of the company and the current valuation, it did seem like a bargain. I would add on top of that it had a very low debt and a high return on invested capital, and it seemed to me like a very solid management. So I really like the company. I still do. I still like the company. But the problem was that, yes, I invested kinda, you can say it was value, but I counted on this growth. I expected this growth. I assumed there would be growth in the company. And again, it's kinda unfair example. I don't have a better example, because the earnings are completely fell. And of course, when earnings fall, the price is gonna fall, and there is no bottom, like I said. But that's just the best example I have. My point is not in the collapse of the earnings, but in the fact that it was growth investing, because I counted on this growth. Because if earnings would have been flat from here, I don't know where my investment would be right now. I mean, my investment, my thesis would have been successful only if the growth continued. And this is a cyclical stock. And of course, growth is not only not going to continue, it's going to absolutely plummet. During a downturn in the economy like it is now. I'm still holding on to it. I think there is an upside to it. I can make a separate video to it about it. But just to illustrate how I thought that growth investing and value investing are not that different, and that let me get back to full screen. Yeah, like I thought that value investing and growth investing are not that different. Like I bought the whole story that it's pretty much the same, and you can invest in growth companies when you think the intrinsic value is higher, when you take into consideration the future growth of the company. And then if you buy it at a discount, then it's also value investing. But no, for me, I am from now on, I'm making the absolute distinction. Again, it's a matter of semantics, but if I assume a growth of above, I don't know, 6, 7, 8% for a company, it's a growth investing. And if I don't, and it's still trading at a cheaper price than what I think is a fair value for this company, then it's value investing. That's the distinction I'm making from now on, and I think it's completely different. And it also has different risk reward profiles, like I said when I already explained that, but just to repeat myself, where with growth stocks, once one really takes a risk where growth slows or stops or even declines, and then the valuation is completely changed for the company. The market will reevaluate completely the company. And like we saw with Alibaba, it could be 3 times difference in the price of the company, in the valuation, on the multiple that the market is giving the company. So it's a huge risk. Again, the higher the growth, the higher the risk. While with the value investing, your biggest risk would usually be that there is a good reason for the stock price to be down, and the upside that you see is not necessarily going to materialize, because if a company is trading at a lower price than even the fair value you think it should have, if it doesn't grow, there would usually be it means it's trading really cheaply, and there would usually be a good reason for it. So again, different risks, different rewards also, because with growth stocks, you kind of hold them while the growth is there, and it could be many years. And then after many years, if the growth slows, you're still very much on this position. And while the reward with value investing, you like wait for a few years for some a catalyst, or for the market to like change its sentiment, or see something that you saw that didn't see with the stock, and and just have this upside, which is usually also more limited. So just different profile of investing. I do think there is a difference. Of course, again, there might be gray areas. So what do I think is a better investing? The growth part that I spoke of, or the value part? And I guess that from the way I talked about it until now, it sounds like I prefer the value part of it, but not necessarily. I think the sweet spot is in low growth companies. And I think that's also unknowingly somewhere in the back of my mind that was one of the many reasons I chose the strategy I'm doing right now with dividend stocks, where I choose companies which don't grow very fast, but they do have this uptrend in earnings that is kind of moderate. I try, of course, not all of them, and there is some variation to it. But I think that high growth companies, you have this big risk, which I talked about, which I said many times already, of slowing growth. And with no growth companies, there are few risks. One of them is the one I just mentioned, where it's probably trading really cheap for you to think that there is still a margin of safety, even in the case of no growth. So there usually would be a good reason for this cheapness, for so much undervaluation. And there are plenty of value traps out there. But I think also another risk with no growth companies is that they usually really will be desperate, absolutely desperate, the management, of showing zero growth or 1% growth or just 1% decline or 2% growth or 2% decline. I mean, they would be so desperate of not showing any decline, even if there is a sudden more decline. I mean, if a company that is pretty much flat is suddenly reporting minus 3% even in earnings, it's going to be significant for the sentiment of the market. And I think managements will go along despicable ways to not show this -2, -3 declines, to show like this 0 or +1, which I never ever trust. There would be, I think usually companies where they're always like -1, +1 in earnings, there are usually financial shenanigans there. And also they might, to keep this growth, they might also do like stupid things like irresponsible acquisitions and venturing into different business strategies and different business models and entering a whole new field where the company has no experience in. And it's that dangerous part in the cycle of a company, which I can make like 10 videos about, a very interesting topic where a company is starting kind of to decline. It's on the verge of declining. It's just one step away from beginning to decline, and it will just hang in there at almost any price. Of course, I'm making a terrible generalization here, but there are the incentives here for the management to keep on showing these flat earnings, and that always scares me. So I think the sweet spot is finding companies which grow like 2%, 3%, 4%, 5%, 6%. I think that's maybe 7%, that's the top. And then it's not too high of a growth when you're scared for it to stop. And it's not so low of a growth that you're kind of suspicious, is it even there? And when it'll begin to decline. So I think in terms of growth, it's a perfect sweet spot. And then it's easier to spot an undervaluation also. However you look at it and however you measure it, it's also easier to see when there is a margin of safety from the current price, from the fair price, like the expected low growth next year, or even if the growth is a little bit less next year, if the growth is a little bit high next year, that the range is so much more narrow, so your risks are lower also. So that's my conclusions on growth versus value investing. Probably not a popular opinion, but oh well, that's me. And I don't know, I just had the need to talk about it because I'm in the point where I need to decide what am I doing with my growth stocks. They are not value stocks anymore. They're kind of growth stocks, and now there are turnaround stories, all of them. Where should I keep them? Should I keep them not? Maybe I'll make a separate video about it and to think about it, but just this understanding that from now going on forward, I will probably not be investing in growth stocks because I was burned so much by this slowing growth that completely hammered my portfolio. So I just wanted to share this, and I would love to hear your thoughts. It's a much debated subject. I'm sure y'all have an opinion about it, and we will be glad to hear it. So that's it for today, and I'll see you in the next one. Bye bye.